Thank you for everyone who's just tuned in. Welcome to the BuyAssociation Podcast. My name's Katie Walker, and we are going to be going through everything today that you need to know on property management and mortgages. We are joined by two experts in the field, which is Marcus Docker from Visionary Finance and Matt Eastham from Easthams Co. I'm going to let them do a quick introduction on themselves, and then we've been sent a series of questions from our investors and buyers, and we'll go through them briefly. So firstly, Marcus, can you introduce yourself?
Yeah, sure. Thank you for having me, Katie. I'm Marcus Docker. I'm one of the senior consultants at Visionary Finance. So effectively, we work as an independent mortgage broker. So we support a lot of buyers, from your first-time buyers, your first-time or even seasoned buy-to-let investors. And we do a lot of support with a lot of developers as well. So we help everyone through that journey. We work as an independent whole of market broker. So we do work with more than 90 different banks across the marketplace, just helping people try and make sure we can get the best mortgage deal.
And why do clients choose to work with you?
I think people generally like to work with us because here in the UK, for UK purchasers, we don't charge any mortgage fees. So there are many brokers still that are in the mindset of charging fees. For us, it's a very service related, a very service driven business that we are. We like to build these long-term sustainable working relationships with our clients, and effectively the advice that we're giving is best advice, and that's why people should be looking to work with us.
Great, thank you. And Matt, can you give a quick intro on yourself?
I can, yeah. Thanks for having me, Katie. I'm Matt Eastham. I'm a director of Easthams Co Residential Property Management. We were founded back in 1984, at the start of the buy-to-let boom, and we've always specialised purely in residential property management. We work with a number of UK and overseas landlords, as well as various funds and investment companies. We basically look after your investment from start to finish, from the day you purchase right through to the day you dispose of the asset. We have clients that have been with us for 20 to 30 years. And the reason for that is that, I believe we offer the best property management service currently available in the UK marketplace.
I'm probably going to put the same question to you there.
Yeah.
So why do clients choose to work with you?
They choose to work with us, I think, because of our history. We've sort of grown via word of mouth over the last 30 years. We now manage in excess of 4,000 units across the UK. Our fees are very reasonable. Our service levels are very high. You can always talk to a director of the business. We're not sort of a big faceless organisation, and we genuinely care. We want to make sure that your property gives you the best possible returns. We put the best tenants we can in there, and make sure that we look after it, maintain it, and give you a
Before we get into the more closed questions that we've had put in, I was wondering if you could both get a bit of a summary at the moment, what you think in your separate field, what the current market trends are, and what's really happening in the investment and obviously owner-occupier market.
Okay, yeah. As far as the lettings market's going, it's never been better. City centres are booming. Manchester obviously sort of led the way. And it is still growing at an exceptional rate. Demand is still very high in Manchester, and new developments are coming on board all the time. I think looking further afield, places like secondary cities like Preston, Bolton, Leeds, are quickly climbing up the ranks. Obviously, entry levels are much lower there. And yields are gradually rising as wage growth improves in those areas. I think the north is very strong, but equally there's still lots of areas in the south, London and further afield, where you can find great investment opportunities if you do your homework.
Marcus, how do you work out, in a difference to yield, how do you work out the best way to get an investment, or someone, how do they calculate their investment from?
Yeah, I think obviously working in mortgages, we work very we're very number driven. So I think there's a couple of ways that people like to present investments to potential investors. So you often see a lot of estate agents, some developers potentially sort of pitching the gross yield against the gross purchase price, which I don't actually necessarily think that it's the best way to work out your investment, because I'd say the majority of people are looking more to, most people look to borrow using a mortgage when it comes to making an acquisition to their buy-to-let portfolio. And I think the way that people should be looking to view their investments is by a return on their actual cash investment, as opposed to their gross commitment to that property. So as opposed to working out, well, what's going to be my gross rental income against the total purchase price, actually, why don't we scale it back a little bit more and make it a bit more real, and actually say, speak to a mortgage broker, find out what your mortgage is going to cost you every month, and look at your, if you're buying a leasehold property, looking at your ground rent, your service charge costs, speaking to your letting and management guys as well, finding out what your monthly cost is there. And then actually you can get a better idea on what your net return will be after you deducted those real costs and what that is as a percentage to your cash investment into acquiring that property.
In your opinion, when is the right time to get mortgage funder in place when you've bought in the residential market?
Yeah, it depends. I think if you're buying, something off plan, for example. So if you've got people that, you often find now there's a lot of people that are committing to properties off plan. You just have to be mindful of the completion dates. I think is really wise just to make sure that you're staying in touch with your agent or the developer that you've purchased that property with, just to get an understanding when that completion date is. Now, it's always wise to speak to your broker first before you actually go ahead and make the commitment to go ahead and buy that property, just to make sure that your circumstances will allow you to make sure that you can complete on that property. But in terms of timing, when it comes to getting ready to get the mortgage in place, it will depend on what type of buyer that you are. So, for example, if you're a foreign national living overseas, we do help a lot of foreign nationals with their mortgage requirements. Those types of buyers are probably going to need a little bit longer to get their mortgages in place, because unfortunately we do deal with some of those lenders that can be quite onerous with paperwork and they can be quite slow. So you just don't want to be making sure that you're left in, you're at the mercy of the lender's turnaround times. So I'd say, a foreign investor, I would give yourself at least 4 months to get your mortgage in place, just to allow yourself enough time. And in terms of being, a buy-to-let investor or an owner-occupier, really, I think the sweet spot is around about 3 months before your build completion date, because mortgage offers are generally valid for 6 months. So if there is potentially an overrun on the completion date from your developer for the delivery of the product, at least you know that you've got 3 months on the other end of the mortgage offer, so you don't have to go back through that process. In
the same respect, when do you think it's best for someone who's just purchased property to come to you to speak about you managing it?
Matt. Again, it's
Sorry.
Again, as Mark said, I think the earlier the better. I mean, quite often we speak to investors before they've even started looking at specific areas to invest in. What you don't want to do is leave it to the last minute, rush, and end up with an agent that isn't right or suitable. Ideally, the minute you start thinking about investing in property, start speaking to agents, find out what's out there, what services agents offer. Look online for reviews, try and speak to other investors that have used agents, and just get a good feel, because there's a massive choice in agents and services, and it's important to find one that offers the package that works best for you.
So a lot of questions we got were similar and matched this kind of question. People were asking what properties demanded a higher rent in your opinion, and also what properties attracted, I guess, a nicer tenant. Like, what's the better property to buy to get that better tenant?
It's a tricky one. I mean, there's no sort of right or wrong answer, but I think we've seen definitely a trend in more and more young professionals looking for 2-bedroom properties. I think people are wanting to share, to reduce their overheads, to give them more free cash to travel or socialise, or that's what it seems to be about now for Generation Rent. It's about experiences and not wanting to throw all your money at rent for a nice big flash apartment. So as a result of that, we've definitely seen a spike in demand for 2-bedroom properties, and I think developers tend to build less 2-bedroom properties. So again, there's a slight sort of shortfall.
That's interesting, because we find mainly that 1-beds sell a lot quicker.
Definitely. They do. I mean, the 1-beds, obviously the entry price point is much lower. So investors see that as a better entry point. But I think long term, and I think in terms of resale and everything else, I would veer slightly towards 2-bed at the moment, the way the market is. And that does vary from city to city, and it depends on the current number of 1-beds in any given city centre, or 2-bed. So again, it's important to do your groundwork. Look on Rightmove, Zoopla, see what's on the market. you can quite easily go on Rightmove and Zoopla and see how long it's taking properties to let. Do that
Yeah.
kind of research first. But yeah, I think 2 beds for me at the moment are the way forward in terms of.
I think you raise a good point about the city locations as
Yeah.
well, because I often find working between sort of different demographics in the
Yeah.
UK, so helping clients that are buying different properties in different locations.
Yeah.
We often find it's quite interesting that you see sort of the 2 beds becoming more sort of sought after up in the northern locations, but actually, things like studio flats and smaller units are actually more sought after in the London areas, because people want to spend as little as possible living in the sort of city centre location, particularly in the capital like London, where it is so expensive to rent.
Yeah.
So you often find that actually the studios are actually quite sought after in those locations, particularly in London.
That's a really good point, and it's something we've seen. I mean, we've seen obviously in the news people talking about micro apartments and micro living, and we know of a couple of developers who've tried it in the north and felt miserably. It just doesn't work. But in London, you've got people queuing up for them. It's good point.
So, Marcus, can you tell me what are the benefits of using a broker v going direct to a bank to get finance?
Yeah, definitely. I think there seems to be this perception for customers who with their bank that they feel that they would get either a better service, or they would get a better rate or a better deal or something. But it's great to have that relationship with your bank, but it's not always the best thing to do. So. Mortgage lenders and banks are very heavily dependent on the mortgage intermediary market. So you would have seen recently that Santander made a large number of redundancies in their mortgage teams, because effectively banks don't want to carry those overheads by employing masses of mortgage advisors in their branches. So what they do, they farm that out to the mortgage intermediary market, like ourselves, the brokers, who effectively facilitate those mortgage applications. Now, that allows the banks to be more competitive in their pricing, because I'm sure that obviously by not carrying those overheads, that they can they can afford to do more business and heavily invest into their administration teams. But effectively, what people need to know from mortgages is that it's not a one size fits all approach, and we often find that when we make recommendations to customers, they can see that there are other mortgage products available when they're going on to go compare. But I think what customers need to understand is that banks vary themselves not just on price, but they vary themselves on their lending criteria, and it's a mortgage broker's job to be able to make that recommendation, to make sure that they're advising to go with a lender where your circumstances are conducive to their lending policy. So I think you might well sort of go to your bank direct and you'll make a mortgage application. You could well pay a valuation fee, which could cost you a few £100s. And you might actually find that even though you've got a very good relationship with your bank, your circumstances don't meet their criteria. You'll end up getting declined, and you'll lose your valuation fee.
We see that all the time. People using their own banks and being declined. And they go to a broker and they get it straight through. So I think that's sort of where it's key, and the broker can save you money. We fully understand that there are brokers out there that are charging fees, and that's why people don't want to use brokers, because they don't want to pay that fee. But someone like ourselves, what we've done is actually said, you know what, let's take the fee away, and let's make sure that we get on side with the clients there. We can get them the best mortgage rate based on the circumstances, and try and get it through first time to save them time, money and effort along the way.
So following on from that, how do you think a client can make the process easier and smoother for themselves?
Yeah, I think everything's all in the preparation. It depends what type of buyer that you are. So, for example, as a foreign national, let's use that as an example for now, where we see a lot of these foreign nationals now heavily invested into different marketplaces, particularly outside of London now, like Birmingham, Manchester, places like that. And everything's all in the preparation. So just making sure that you've got like a UK bank account open. So what you don't want to be left in is a situation where a developer's served 10 days notice on you, and you're trying to scarp around trying to get your mortgage in place, and then the bank turns around and tells you haven't even got a UK account. So everything is all in the preparation. Speak to your mortgage broker early. Discuss your situation as early as possible, so then they can advise you on what type of paperwork that you're likely to need. So things like people who are self-employed, they might require your tax returns. It might well be that you need to structure your company in such a way to help yourself when it comes to the mortgage process. So everything is all in that preparation. So speak to your mortgage broker as early as possible.
And are you still encouraging investors to set up a limited company now? Is that, in your view, is that still definitely the way forward? Do you see the government clamping down on that anytime soon? Or?
Yeah, so I think we get asked about limited companies a lot, and it really depends on the client's circumstances. So it's not so much that we will advise everyone to go out and incorporate a limited company from the outset because there's tax advantages available for those people. It really depends on what type of what tax band that you're in. So with all the new tax changes that are coming in around mortgage interest relief, and those regulations that take their full grip in 2021, it really depends on what tax band that you're in. So these new tax changes don't really affect basic rate taxpayers. It's those people who are in the higher rate or the additional rate tax bands that it'll affect. So it's not that we're just saying rush out, go and set up this limited company. It really just depends on your income.
We did have a lot of questions come in about that, like purchasing a property via either the personal or company route. Yeah. And I think, to be honest, there's a lot of education that needs to go into that because people don't fully understand maybe the company side of it, or as soon as we speak about with our clients the potential to purchase down that route, it seems too complicated. I mean, is it a complicated?
No, definitely not. I think it sounds a bit more daunting. So when it comes to the point where we can put the option on the table for a client to consider purchasing in a limited company, it sounds a bit of a daunting process, but it's actually, the process itself is pretty similar in the sense that the underwriting process, the way that the bank assesses the mortgage is very similar. You ask for the same documents. The company's structure is just basically a tax efficient wrapper. So instead of owning it under Mr. and Mrs. Jones, you own it under Mr. and Mrs. Jones Limited. So lenders are not looking for track record on limited companies.
Do you have to be in a certain bracket to do that though, to open the company to purchase it?
No, anyone can open a company.
Oh, right.
Yeah, anyone can do it. So it's relatively straightforward. You can have a company registered within 4 hours on Companies House. So it's quite a quick, straightforward process. I think it only costs about £20 in order to incorporate, so it's pretty quick and easy. So those people who are considering it, just make sure you speak to your accountant to make sure you're getting proper tax advice before you go ahead and do that. But I think people get quite daunted about the limited company structure and how it works. But like I said, the whole process is exactly the same. It just allows you to be a bit more tax efficient, which we'll touch on a bit later. With your investment. And
are there any restrictions in terms of sort of loan to value you can get with buying through a company, or is it similar to an investor buying on their own?
Yeah, so what we're finding is a lot of people now are going down the limited company route because they can actually raise more money through a limited company than what they can through a personal name. Okay. So with what lenders do, they apply a rental stress test calculation on the proposed rental income of that property. And the lenders apply a stress test for that in order to sort of derive what the maximum borrowing will be. Now, for those that are in the higher rate and additional rate taxpayers, for using this as an example, property in London, where they're very low yielding, the average loan to value now in London for a person as a higher rate additional rate taxpayer buying a property down there is on average between sort of 60 to 65%. Right. And most people are looking for those sort of higher loan to values, the 75, potentially 80% loan to value mortgages. Yeah. And the only way to access those for those people that are in those tax bands are through limited companies because they apply a bit more of a relaxed stress test to the rental income that's coming in. So it will allow you to get to those higher LTVs. Okay.
One thing we were asked quite a lot is about the current letting fee ban, and is this going to affect you negatively? Is it going to affect landlords negatively, or what's your opinion on the matter?
I think in general it's a good thing for the industry. It's obviously good for tenants who were being had for hundreds of pounds every time they moved property for a £2.50 credit check. It's going to be good for landlords. I think a lot of landlords didn't realise, but sometimes by going with a particular agent, they were actually having a negative impact on their ability to let the property. A lot of tenants had boycotted big companies like Countrywide, who were charging £500 a pop. So they might see a flat that they absolutely loved, but they'd go down the road and choose something else where they could get a fee of £100 rather than £500. So it just creates a much more level playing field. I think letting agents, property management companies have had a pretty horrendous rep for a number of years for these sort of underhand fees and things. So it just creates a more professional.
Do you think that it will have an effect on the market rents though, because I feel that yes, that it's all well and good that the government are trying to standardise tenant fees, which I think
but is it just going to put into the rent to make
exactly? So our landlord, can agents afford to absorb those costs? Well, I don't think they will. So are they going to start charging higher letting and management fees to their customers? And then landlords will then in effect have to drive their rents up. So we're invariably the rent is going to end up costing tenants more anyway, so it's a cyclical.
Yeah, of course. Yeah, I mean, there is definitely a danger of that. I mean, we've seen it already with some high street agents, increasing the fees to landlords to cover that shortfall. I think the better agents always kept fees relatively low, so hopefully it won't have the same impact. And a lot of agents are looking outside, charging landlords in terms of doing things like guaranteed rents, insurances. They're getting money back on utilities transfers and things like that. So there's other ways that they can claw back some of that lost revenue. In certain areas, certainly where affordability allows, landlords will naturally push rents up, and I think that's possibly more in the south than the north. Wages are still at a much lower level than the south and the north. So what we're seeing in a lot of the big cities is that rents are already levelling out due to affordability. But as soon as wage growth increases, inevitably, the minute landlords see that and investors, they'll start pushing those rents up to try and increase that income.
And why do you think, in your opinion, someone would invest in a buy-to-let property?
I think, historically, property's always been one of the best investment vehicles. It's historically performed better than pretty much anything else, I think, across the board over the last 100 years of home ownership. There'll always be peaks and troughs. I think the people who do well are the people that look at it as a long-term investment. I think, the people who jump in and want to invest for 5 years hoping to make 25% capital growth and have 9% yields are kidding themselves. It's very difficult to time the market. No one can time the market. It's luck more than anything. So I think you've really got to have a long-term investment strategy. And I think if you buy in the right area and you buy the right thing, over the long term, you can't really go wrong.
It's not. I think the benefit of it as well is just it's not an illiquid asset. It's something that you can make the choice of when you choose to dispose of it during that peaks and troughs period. So I think it's not like stocks and shares and things like that. While they do perform very well, at times. They come with higher risks, and I think
fluctuate wildly, don't they, in very short spaces of time?
Exactly. I think it depends on what your risk is as an investor. So if you have that high risk attitude, then you probably you're probably someone that will back something like stocks and shares. Or if you have a very very low risk attitude, then you're probably looking at ISAs and bonds and things like that, which don't really yield you anything. So I think property is something in the middle where effectively you can look at it as a long-term investment. It's steady. Like Matt's already said, it's something that over time or increases in value by taking that long-term picture. So I think it's something to be considered.
And as I think the government have said recently, that obviously home ownership is on the decline. And by 2035, I think they said there's going to be more renters than homeowners potentially. So
And if you've purchased a buy-to-let, why do you think someone should use a property management company v trying to manage it themselves?
I think there's a couple of reasons. I mean, the first one is time. I think people forget how much time it can take to manage a property. Just simple things like utilities transfers. You send the details off to utilities company, they write back with the wrong name on it, the wrong meter readings. You then spend 4 or 5 hours on the phone just getting your gas transferred from the previous tenant's name into the new tenant's name. Trying to organise maintenance where you've got 5 or 6 phone calls between a landlord and a tenant and a contractor to organise times and things like that. Legislation is a massive one now. Obviously, it's constantly changing. You need to be on the ball. You need to know what's happening at all times. Otherwise, you can find yourself in real bother. I generally think a good property management company is worth their weight in gold.
So one thing I really wanted to bring up today, as we ourselves are coming to completions on a lot of site, is a question for you, Marcus. So in terms of valuations, can you explain the difference between a desktop and a physical valuation? And we did have someone who's put a question in because they've just been undervalued. Yeah. And what steps to take if that happens?
Sure. Well, I think it's good just to start off on just the valuation itself. Yeah. So typically, valuation is just an objective opinion from a valuer that's appointed on behalf of the bank. Now, what people just need to understand is that if they do get a down valuation on a property, it doesn't necessarily mean that that's what the property is worth. It's just an objective opinion based on that valuer's research. Now, there are a few valuation firms that are out there. There aren't many, unfortunately, which unfortunately gives a lot of control to the valuers who are working on behalf of these lenders. So I would probably say there are 4 main valuation firms that control probably around about sort of 70-80% of the mortgage market. So they're instructed on behalf of a lot of these lenders. And effectively, what people need to understand is that these valuers are they're not paid to take risk. They're completely separate companies. They're not valuers that are owned by the bank. They're third-party companies. And effectively, back in when we had the financial crisis, a lot of these valuers were sued against their professional indemnity insurances. So what we're finding a lot of these valuers during this uncertain time, politically, economically at the moment, is that they're taking a very cautious approach in their appraisals because they don't have to go over and above, where they feel the market values are. So what they're finding is, I think what the key thing for people to do if you are buying a property is try and do your research for the valuer. Don't give the valuer an opportunity to down value your property if you've got some really strong comparables in the area. So we're doing a lot of work with a lot of developers in a few different cities at the moment that have built out these sites. And it's all in the preparations, just making sure. Unfortunately, we have to do the work for the valuer, so we have to be very strategic in the approach, get the comparables. So working very closely with people like Matt and his team, and sales teams that are in other developments which are nearby, to make sure we can draw some very good comparables and provide a really good pack to these valuers that go onto site to make sure that we can back up and justify the values that you've purchased at. But people just don't need to worry if they do get a down valuation. I think the key is to go and speak to a broker who knows what they're doing, because what they'll be able to do is maybe resubmit that application to possibly another lender who uses a different valuation firm, who will likely probably give you a different outcome on the valuation itself. So I wouldn't sort of say take what they say as gospel. You can always speak to someone and get another opinion.
Are there any mortgage lenders at the moment in particular that are down valuing properties? Is it to be wary of?
Without name and shaming people. I think there are some valuers that are more cautious than others. And I think we're mindful of that, particularly in the new build space. So we try to sort of, just take a measured approach when it comes to doing mortgages on these sites.
So you could guide investors towards another lender if you felt there was a danger of
I mean, our advice always has to be transparent. So we'd have to give, obviously we work in a regulated industry, so we have to make sure that we give best advice to the customer to make sure it's, but just to make sure that the customer understands the advice that they've been given and why we would be recommending another lender, because the rate ultimately might be a bit more expensive than going with a cheaper lender who uses a valuation firm who is, let's say, a bit more cautious. So, I would say that that's sort of the lowdown with valuers at the moment. And with regards to what types of valuations that they carry out, just bringing you on to the other point that you raised about desktop versus on-site appraisals, I think that what developers and customers need to be made aware of, and this all comes back to the timings that we discussed, is that we don't want to give valuers that opportunity to down value that property, because if we give valuers the opportunity to value property off plan, there can be a tendency, particularly on the new build area, for valuers to value on a pound per square foot basis. And it doesn't really give the valuer the opportunity to see the quality. If you've bought a really good quality product with all the bells and whistles, it doesn't really give the valuer the opportunity to see what type of finish that property is. What sort of mod cons are going to be in that apartment in order to justify that property's value. So you're more likely to get a down valuation on an off-plan valuation, as opposed to a valuation that's carried out in the right time frame, where a valuer can walk on the site without any PPE and actually have a look around the property, and you can give him all the justification in order to value that property.
Is there certain things that the property developer should take into account, which the valuation companies do to help the completions?
Yeah, I think this is an area that we've been very successful in as a firm. We sort of tend to specialise in this area with supporting developers, and I think that you have to take a very strategic approach, and it varies on a development by development basis. So what we would do is, as specialist new build brokers, is actually sit back. We would have a look at what types of buyers have bought in that development, who have they been sold to, what are the terms of the sales. So things like, there's a lot of legislation in the press now around onerous ground rents. So this is an area which is very hot at the moment, where ground rents that exceed 0.1% of purchase price are considered onerous, and a lot of these people who have exchanged off plan may find themselves caught in a trap where they've bought something where the ground rent exceeds that, and they struggle to get mortgages. So what we would do with the developer, we would actually sit down and devise a strategy around the types of buyers that they've sold to, who they are, where they are they are they overseas. And then work with their team of people, people like BuyAssociation and Matt's team. Effectively, we'd sit down and get the rents and the market appraisals on those units, and we would try and carry out like a pre-appraisal process on that development prior to actually starting the mortgage application, to get an idea of how likely we are to get these through.
Right.
Because of certain political things I'm not going to mention, but the market is seen slightly uncertain at the moment. How have you found that's affected the interest rate, or do you think the current mortgage interest rate is strong? And I guess the same with rents, but I'm quite curious. As do you think it's affected the mortgage interest rate, or?
I think that there's banks are competing fiercely on customers, for new customers. I think banks are not very good at keeping their existing customer base, because you often find where people come to the end of their fixed rates, they offer product transfers which are generally more expensive than their initial fixed rate. So banks are not very good at keeping the customers, so there's a huge remortgage opportunity out there. But what we are seeing is that buy-to-let rates are very, very competitive still. So you can get buy-to-lets in a personal name, sort of 65-70% loan to value from around about 1.5% still. Which just goes to show that it's still that's a very, very cheap. That's very competitive. That's sort of quite comparable to residential rates. So buy-to-let rates are sort of 1.5%. We are, for those that are investing under the limited company structure, even those rates are actually falling as well. So with the tax changes being announced, a couple of years ago now, limited company buy-to-let rates were around the 4.5%, 5% area. Now we're finding limited company rates around sort of the high twos.
Okay.
Which just goes to show there's a lot of people sort of competing for that new business. So I can't see rates moving massively. I think we need to be, whatever happens here in the UK, I think what we need to understand is that we want to attract investment here, and the only way to do that is to make sure that we can be competitive from a tax perspective, and also making sure that we can borrow money cheap as well. So I think that's what we need to consider.
Do you ever think we'll see a return to the days of kind of 90-95% buy-to-let mortgages? Once bitten, twice shy?
Yeah, definitely not. I can't see us going back to those high LTV mortgages on the buy-to-let side. But still there are some very there's some very good LTV mortgages still available for buy-to-let investors, for those people who are buying property with the correct yields. So we are seeing some specialist lenders go up to as far as 85% on buy-to-let. Rates are not competitive, of course. Obviously, the higher that you go up the LTV scale, but you're probably looking sort of 5% plus in those sorts of LTV bands. But if you've got a fantastic investment which yields you some great returns, I'm sure you could probably still make that work for you.
So where do you think is currently achieving high rental yields, Matt? Or where are you finding?
I think the highest yields are in the north. Entry price is the lowest. You can pick up property for peanuts in certain areas up north. And I think that's probably going to be the trend going forward, because of the low price entry point and obviously the expected sort of wage growth that we're hoping to see over the next few years. But it's not always about yield. You've got to look at capital growth as well. Even further down the line, when you come to dispose of the asset, how easy is it going to be to get rid of? One of the main things that people forget about is that at some point they're going to want to sell it.
The exit strategy.
Exactly. Yeah, it's amazing how many people don't factor that in. So it's.
I'm coming across more and more at the moment as the north is developing and becoming more of an attractive area for people to invest now. as an area. I'm seeing more and more people that are investing in sort of 30, 40, 50,000 pound properties, and actually, because it's cheap, it doesn't necessarily mean it's right. Because I think, like you just clearly said, it needs to be saleable. It needs to have a good market, a good marketability to get a tenant in there as well. But even from just bringing it to the mortgage perspective, it's actually very difficult to get mortgages for properties of those values, because a lot of banks have minimum property valuations. They have minimum loan sizes as well.
I didn't know that.
So we often find that some people that are going up into these northern counties and buying properties for 40, 50 grand actually can be quite difficult to finance as well. So it's just because it's cheap sometimes it doesn't mean it's always right.
One thing we want to touch on as well, is we've had a few questions come in. Obviously, with off-plan, sometimes people can purchase 2-3 years in advance of a site completing. So within that time, you can sometimes get contracts that have been reassigned. So someone's purchased right at the beginning, and then they may choose to sell that before the project completes. Does that affect financing at all, Marcus? Or can people get mortgages on those contracts that have essentially been flipped by the first?
So assignable contracts were very popular back in sort of 2007, 2008, and obviously the market lost control back then. So they were very, very popular. Now, the bank's experience from those days was that a lot of they did have their fingers burnt. The banks lost a lot of money. So what we often find now is that a lot of lenders don't lend on assignable contracts because of what happened. Now, what we have seen is it isn't impossible to get finance on an assignable contract, so it's not completely impossible, but it depends on what type of buyer that you are. So, for example, if you are a residential or a prospective residential homeowner that wants to buy an assignable contract for yourself to live in, there are mortgage options available, but what people need to understand is that you are not going to have the whole choice of the market, and this is where a specialist mortgage broker will be able to support you with that. So typically what you'll see for people who are buying assignable contracts for residential use, the bank will typically lend against the original purchase price. So, for example, whoever bought the property first from the developer, disregarding any uplift in profit from that original buyer, the bank will only lend against the original purchase price, and that's generally around about sort of the 70% figure. So that's on the basis that you're owning it yourself to live in. The other option is for people who are purchasing it for a buy-to-let investment purposes. That becomes a bit more difficult again. So there are really, really not many lenders that will do it, unless you want to go to your tier 3 lenders, which are your bridging finance companies or your expensive buy-to-let companies, which will do it. And again, they will only lend a certain percentage against the original purchase price. But it can be done. I think what you need to sort of weigh up is is it worth it? I think that's what needs to be considered. Okay.
One thing I want to speak about as well is the Help to Buy scheme. So a lot more developers now, off-plan developers, are getting involved in this and, helping those first-time owner-occupiers get on the property ladder, which is great. I think there's a massive lack of education in the marketplace on this Help to Buy scheme, though, and who is eligible, who can partake. Because something that surprised me, someone sent a question in saying that although they live in the UK, they're not actually a UK passport holder or UK citizen, so they can't partake in the scheme, which is not right. So can you touch slightly on that, and who is eligible and who can take part in the scheme? Yeah,
definitely. Help to Buy is a fantastic scheme that needs to be taken advantage of while it's here. Fortunately, the government have now extended that until 2023 now, which is great, but they've become a bit more strict on the terms on how they offer that. So what I'll do, I'll sort of talk about it currently and then what those changes are going to be. So effectively, Help to Buy, depending on where you're buying. So there's two types. So there's Help to Buy London and then your standard Help to Buy. So generally, if you're buying in a London borough, the government will lend you up to 40% of the value of the property. And that's interest-free for 5 years. And the contribution that you would need to make is as little as 5%. So effectively what you've got is a 45% deposit, and you can borrow 55% from the bank. If you're buying outside of London, that equity loan that you borrow from the government is reduced from 40% down to 20%. So again, with your 5% deposit, you now have a 25% deposit and you will borrow 75% from the lender. Now, it really is a good scheme, and what we are seeing, there's still a lot of transactions happening in the marketplace using Help to Buy, because there really is a couple of advantages that people need to consider when using this. And one of the main advantages that we often find is that people can actually afford to buy a property, a higher value property using Help to Buy when compared to just buying a property under standard terms, just under a standard mortgage. So from an affordability perspective, it might actually help those people that are going out buying a property for residential use. So instead of just making putting your first sort of foot on the housing ladder to buy maybe a studio or a 1-bed flat, using Help to Buy actually might allow you to buy that 3-bedroom terraced or semi-detached, in order to avoid you having to sell that property initially and then pay the stamp duty again in order to buy the house that when your position changes. So I think that's one of the factors that need to be considered. But the second thing as well is also the interest rates that are available to people on Help to Buy. So looking at a trade-off, for example, if you've got a client that's simply just got a 5% deposit, a 95% mortgage interest rates, you're probably looking around about sort of 3.5%, 4%, maybe more than that, depending on what type of lender that you're looking to approach. Whereas, using Help to Buy, there's interest rates available from as low as 1.6%, which is a huge savings. So what it allows you to do is actually build up a lot of equity quickly in that property, to allow you to sort of pay down that mortgage very quickly. So not only is your monthly payments a lot more affordable on a month-by-month basis, you're not paying heaps amount of interest costs on your monthly mortgage that you are paying, and it means you do own 100% of that property. So all the government are doing, they're just taking an equity stake in your property. But I think a huge advantage in addition to those, which I think people don't often catch, is that the equity loan that you're borrowing from the government actually moves with the value of the property. So I often get people say, if the property value increases by 100 grand, then I've got to give 20% of the profits to the government. And yes, that is absolutely true. But I think what you need to look at is sort of wind it back a little bit and actually have a look in how much you're saving in interest costs compared to paying that 4% interest rate as if you would buy using just a traditional mortgage. But just looking at the flip side of the market, because we are in a very uncertain time politically, economically, like we all know at the moment. And, if there is a chance that the property value does decrease, the equity loan that you've borrowed from the government also decreases. Yeah. So actually it works on the contrary. So there could be a position, if you have a 5-year plan and staying in that property, and let's say market values drop by, say, 10% in the next 2 years, if that were ever to happen, technically speaking, you would actually end up paying less back to the government than what you borrowed. Okay. So it's a good way of sort of hedging your bets, hedging your risk in the housing market. Instead of being 100% responsible for any decreases in market valuations, actually you're only, depending on where you bought, you're actually only slightly geared into that investment yourself when you buy it.
So, I've personally not got much experience with the Help to Buy, but with the government loan, how long have you got to repay that loan? And what happens at the end of that period?
So the equity loan, in theory, you can actually borrow for up to 25 years. You can actually borrow that money from the government for 25 years. But basically, for the first 5 years, that equity loan is free of charge. So you don't pay any interest on it. You don't make any capital payments back during that 5-year period. So people tend to make a sort of 5-year plan on the equity loan. So they have plans from year 6 onwards in order to make those repayments. Now, I often get asked from people, well, what do I do after 5 years? What are my options? How do I get out of Help to Buy? And it's quite simple. I think that there are a few options. So, typically speaking, people really should be saving. So what they're saving on their monthly payment, they should be really looking to make efforts to make any disposable income and save that up in an interest-bearing account. So when it comes to the maturity date, if you want to redeem that equity loan after the 5-year interest-free period, then you've got a lump sum there which you can try and clear down part of that loan. Some people potentially look to sell their properties at the end of the 5-year period. So, they might just say, well, do you know what? Actually, we've been here long enough now.
Yeah.
Now's the time, because our life circumstances have changed. You might have kids or a family or
and
whatever.
at that time, they don't repay the government what they've borrowed. They pay them the percentage. So if the property's gone up or down.
Yeah, so the property would be revalued at
Yeah.
the point of redemption. So it would be revalued when it comes to clearing it off. So they'll be able to get an understanding of what that property value is. So this is going to be actually quite an interesting area when all these equity loans come up for renewal, because the market conditions at the moment, where it's quite common sometimes for down valuations in different market areas, we got banks which is in their interest to down value properties, but actually now we're going to find is it in the government's interest to boost up values because they want their profit. So it's going to be quite interesting to see how those values stack up. But yeah, so I think that there are a couple of the options that people should be looking at. If they look to sell, then they have to pay off that equity loan. They can't leave it outstanding. Or the third option is, depending on what market conditions are like at that time, it could well be, if interest rates do increase in the next 5 years, it could well be cheaper, because from year 6 onwards, you are going to pay interest on that loan, and that's at 1.75% plus RPI plus 1% at the time. So it could well be cheaper for you to continue to borrow from the government loan than actually remortgage and borrow from the bank.
Right,
so it could be in your interest to actually leave that run, and that will be part of the service that really your mortgage mortgage broker should be doing when it comes to appraising your position at the end of the Help to Buy equity loan scheme. That's really what they should be looking to do.
Okay. And at the moment, obviously, also what's getting a lot of press is the government announcement about the planned changes to the eviction process. So what do you think? What's your advice, I guess, if Section 21 is abolished, or do you think they are going to?
I think now that they've said it, they'll follow through with it. I hope there's a decent period of consultation prior to them abolishing it with industry experts to make sure that something is put in place that will still allow landlords to evict for non-payment of rent, damage to properties, if they need to sell, which I'm sure they will do. But yeah, it's a bit of a storm in the teacup. I think generally landlords don't evict tenants for any other reason than not paying the rent, damaging the property. It's a bit of a vote winner, I think, for aimed at generation rent. But yeah, I don't think there's anything to worry about. And I think landlords will always be protected in terms of being able to evict tenants if they need to do that.
So for those who are listening who've never really heard the term generation rent before, or if they haven't, how would you explain generation rent?
I think it started probably 20, 30 years ago, and it was at the start of the house price boom back in the sort of late 80s, early 90s. I think people became priced out of the market. Every generation before that, it was taken as granted that you would buy a property. You got married at 20, had kids, bought a property, and that was it. You were kind of set up. With each generation from that point onwards, prices have got steeper and steeper. Inflation's got higher, the cost of living's got higher, and it's now no longer standard practice to buy a house in your 20s. So people began renting. At the start, there were private landlords who rented out terraced houses, small flats to young people. Since then, it's grown and grown, and more landlords have come into the field. The government are now pushing institutional investment by means of build to rent. And
generation rent's almost become like the target tenant, I think, really.
Yeah, I mean, it's growing and growing. More and more people are in that position, and I think to a certain extent now, maybe younger generations aren't as bothered about being homeowners. I know the government are saying yes, they are, but there's been lots of surveys to say, well, actually, no, we like that flexibility. We like to be able to move around the country. A lot of them don't work in offices anymore. They can live wherever they want and work online. So. And obviously that initial phase of generation rent are now older, they're having children, they're moving into the suburbs, renting 3-bed semi-detached houses, so that's boosted that market, leaving the city.
So you're even finding that it goes to houses as well as flats?
Yeah, I mean, right the way through. I mean, I think generation rent will encompass, retirees before too long. People may never own, but as long as they have that long-term stability and the right quality of accommodation, I don't necessarily think it's a bad thing. There's a lot to be said for not having a big mortgage hanging around your neck.
Yeah.
So
I think we've pretty much covered every question that's come in in some way or form. So we'll probably wrap up, but thank you so much for joining us today.
Thanks for having us.
I feel like even
Thank
I've
you.
learned things.
Yeah.
So
Thank you.
I think people have listened too. So yeah, thank you guys.
Thank you
Thank
for having
you.
us.
Yeah,
Thank
thanks
you.
very much.
Thank you.